All right, I think we're good to go. Good morning, everyone. My name is Mona Iganian. I'm with OCE, part of the Autonomous Vehicle Innovation Network, or AVIN. It is my great pleasure to welcome you to our webinar today, which promises to be an enlightening and informative session. Today's webinar is brought to you by AVIN in partnership with Borden Ladner Gervais, or BLG. So as many of you may be aware, this webinar is the second in a series on how to best navigate the path to financing during COVID-19. In our first webinar, it was back in June, we talked with a panel of experts and we discussed the financing options available to startups and pre-seed companies and outlined funding strategies during these challenging times. So today's webinar will focus on opportunities for financing in the public capital markets. And with today's panel of experts, we will cover key topics, including the impact of COVID-19, why companies are opting to go public, and planning for a successful IPO. So before we get to the topic at hand, I just wanted to say a few brief words about AVIN for those of you who aren't aware of it. So AVIN is the Government of Ontario's flagship initiative on the future of automotive and mobility, led by OCE. Through innovative programming and resources such as R&D funding, talent development support, and testing and demonstration grounds, AVIN is catalyzing the commercialization of advanced automotive and mobility technologies here in the province, driving economic development and supporting our readiness for the adoption and deployment of these technologies. Through our strategic initiatives and thought leadership, AVIN is also driving the sector forward, supporting its transition to the future and helping Ontario to maintain its global leadership position in the space. So you can learn more about AVIN at avinhub.ca, and you can actually catch the first installment of this webinar series there. So just a quick note on the panel itself. So throughout the webinar, you can send your questions through the Q&A function, and then that way we can address what's on your mind. And now I'll hand it over to our moderator. So Manoj Pandit is a partner with BLG, and he will introduce our panelists and kick off our discussion. Over to you, Manoj.
Well, thanks, Mona, and special thanks to AVIN and the entire team at AVIN. AVIN does really important work in developing and fostering the connected and autonomous vehicle sector here in Ontario. It's important work because we have a convergence of manufacturing industry, particularly in the automobile sector. We have grown to become a world technology hub. We've got talent, we've got all the resources, but you need a catalyst, and AVIN does that very well for us. So thank you for doing the important work that you do, and thank you for assisting us in putting this series of sessions together. Introducing myself, I am a corporate partner in the Toronto office at Borden Ladner Gervais. I'm also a member of our firm's Autonomous Vehicles Group. At our firm, our team has significant depth in advising tech and innovation companies. We do this through our numerous practice groups, including corporate commercial, intellectual property, and employment law, just to name a few. We also have a program called Startup and Grow, which is dedicated to assisting founder-led companies in getting off the ground and scaling up, raising angel and VC money, and eventually even selling or going public, or both. And along the way, in dealing with a wide range of legal and even sometimes regulatory matters that arise in the early life of a successful tech company. So our aim in this session is to help companies in the connected and autonomous vehicle space, as well as, I guess, in the broader tech and innovation ecosystem here, to develop a better understanding of the roadmap to accessing the public capital markets, whether that's by way of an IPO or an RTO, short for reverse takeover, on our stock exchanges. Before we dive into this discussion, let's take a quick look at what's happening in our tech market. In 2019, as well as the first half of 2020, we saw a very strong performance by tech companies in the Canadian public markets, the capital markets. In 2019, on the TSX and its junior venture board, you might call it, the TSX Venture Exchange, we saw a 62% return from the Tsx Tech Index. And a total of $8 billion of equity capital was raised. There are 50 new innovation sector company listings, which notably included Lightspeed's $240 million IPO. And the first half of 2020 has also been highly receptive to tech and innovation sector companies. The TSX Tech Index gave investors a 38% total return. The IPO market on the TSX reportedly showed a hunger for new issues among investors, and this has been driving, in some instances, more favorable deal terms and even valuations for these companies, with $2.5 billion of total equity raised. So some of the more notable tech deals in the first 6 months of the year include Shopify's $2.1 billion with a B, billion-dollar financing, Dye & Durham's $150 million IPO, and Miles Hiscock, who's with Canaccord Genuity, will, I'm sure, talk about that in our session. I see its share price is up over 100% since the IPO. Docebo's $75 million deal, its share price is up over 200% since its October 2019 IPO. And a few others like TSXV listed Sangoma, which completed an $80 million bought deal, I think just last month. Mobile gaming company PopReach went public on the venture exchange last month as well. So in this roundtable discussion with our panel of experts, we'll take a closer look at what's happening in the market and what the opportunities are for tech founders and their companies for raising money in the public capital markets, and the planning that's required for a successful IPO, whether that's next year or something that'll happen a few years down the road for any company. And of course, all with the continuing theme of raising capital in turbulent times, the theory is that the pandemic should actually help accelerate tech adoption, and that technology will not only mitigate the impact of the virus, but that it will create new opportunities for investors and entrepreneurs alike. So without delaying this any further, a quick intro. We have on our panel today Brent Layton, co-head technology and investment banking at CIBC Capital Markets. Welcome, Brent. Miles Hiscock, managing director, investment banking, technology, media, and telecom at Canaccord Genuity. Welcome. And last but not least, Rick Nathan, senior managing director at Kensington Capital Partners. Welcome, gentlemen. So I'd like to start off just having each of you introduce yourself in a little more detail, yourself and your respective firms. Starting off with Rick, maybe you could talk to us a little bit about not only the work that you personally do, but your firm in Kensington does and what its investment mandate is with regard to tech companies, and maybe even give us some examples of Kensington's experience where it's invested in a company that's then gone on to go public.
Sure. Thank you very much. I'm happy to be here with all of you today. Kensington, we've been around since 1996. We are active investors across private equity, from venture through growth equity and mid-market buyouts. We have about 25 people on our team, based here in Toronto with office in Vancouver and a partner in Calgary, and managing roughly $1.5 billion in assets under management. We are both fund of funds investors, investing in other venture growth and buyout funds, but also very active direct investors. My role at Kensington is as one of the leaders of the firm. I run our venture capital business, and am very active in many of our portfolio companies, sit on a number of boards. In terms of this sector, the autonomous vehicle sector, it is, and robotics, connected vehicles more broadly, it is an area of great interest. We recently announced, just in May or June was the announcement, that we led the Series C financing round for Clearpath Robotics, Auto Motors, Waterloo-based company, makes autonomous vehicles for the factory floor, and I've joined that board. We are also investors in AvidBots, another Waterloo autonomous robotics company that does floor cleaning robots. They buzz around shopping malls and airports and clean the floor. I think the other one that's relevant is Mojio, a Vancouver and California-based company in the connected vehicle space. So Mojio is a software company, but our customers plug the OBD2 port device and in your car, and then you have an app that gives you all kinds of information about what's going on in your car. You can track your loved ones on the app and see where the car is driving, and various other things like that. So overall, this is a sector that we're paying some close attention to and see some real promise in. One of the things that has struck me about being here in Toronto and being in venture capital is we shouldn't always try to say that we got to try and copy California or any other market. We should try and figure out what is it that we're good at. And in this part of the world, I mean, we're in the manufacturing heartland, Southern Ontario. And at the same time, we have in Toronto and in Waterloo, great technology talent. And so you combine those two together, and it's not surprising that we would be good at industrial robotics, industrial automation. And that is a part of our thesis. I'm happy to get into financing and other discussions, but perhaps others should introduce themselves.
Absolutely, and I would say the one other thing that we're very good at is financing these companies. Some money comes from outside of Canada, but the vast majority of it comes from here in Ontario or broadly speaking out of Canada itself. So Brent, starting with you on the investment banking side, you've had a long career already in advising tech companies. Can you tell us a little bit about what you do now and what CIBC's sort of role is in the marketplace with regard to advising tech and innovation sector companies?
Sure, thanks, Manoj. So hello, everyone, and thanks for hosting us on this great discussion topic today. So I co-head the Technology and Innovation Investment Banking Group for CIBC. I've spent my whole career, the past 20 years, in the tech ecosystem. I actually started my career at Ericsson selling a piece of network hardware that enabled the first iterations of the mobile internet back in the late 90s, and then moved into banking after that. And so I've, over that period, advised most of the Canadian tech ecosystem on a bunch of M&A, strategic transactions, and capital raising initiatives, both privately and publicly. So I've been involved, as has Miles, actually, in a lot of the same names where we've taken great Canadian software and hardware and technology companies public onto both the venture and main TSX exchange. And happy to be here to talk a little bit more about that today.
Well, thanks, Brent. And then, of course, Miles, you and your firm are, of course, very well known in various sectors, but increasingly in the tech space. Tell us a little bit about yourself and your firm.
Yeah, no problem. Thank you, Manoj. A pleasure to be here. So my name is Miles Hiscock. I am Managing Director in our Canaccord Genuity's Global Technology Investment Banking Group based out of Toronto. Canaccord Genuity has been around for longer than most people realize, but kind of had its roots in the greater Vancouver area, and over a series of over a dozen acquisitions have grown the business into a focused provider of growth capital and growth advisory businesses for growth advisory services for businesses globally. And so our organization, we're roughly around 2,500 people spread across 5 continents. Our biggest focus area actually in any geography is either technology or healthcare. It represents over half our business when it comes to the capital raising side or advisory side. Our overall business is kind of split in two between asset management, so folks that manage other people's money, and then what Brent and I do, which is capital markets advisory and capital raising, both for public and private companies. And so I've worked with Brent on a bunch of the public stuff and Rick on a bunch of the private stuff. So we'll have a colorful discussion here. And really, because we're growth focused and frankly started started from the bottom, and here we are, so to speak. We do a cross section of capital raising, and so that includes small ones like we did over the past month on RTOs for companies like Emerge in the commerce space, or Carebook in the digital health space, which we did last month, or frankly in the mid-size, which is a good company. A good example is Blackline Safety, where we just raised $36 million for them last night, or some larger ones, which would be large IPOs for Dye & Durham last month in the midst of COVID, and Canada's first digital IPO, and then or Docebo last year, and frankly just did another follow-on offering for Docebo this week for another $85 million. So kind of active on the small and active on the large, and looking forward to the discussion here around autonomous vehicles, and we've got a pretty good experience, and looking forward to getting people's questions and thoughts around the topic.
That's great. And as we get into the discussion, it'll be really instructive to hear your comments on, the small cap space, particularly, as you say, whether it's through the RTO route or otherwise, but small cap, early stage companies accessing the public capital markets. It may not be for everybody or even a majority of the companies out there, but it seems to be a viable option for some. And we'll be interested to hear, well, all of your thoughts, but particularly, Miles, yours on when it makes sense and when it doesn't. So let's dive into the discussion. What are the factors that impact the founder's decision to go public? What are the key considerations? What is it that drives the companies that are going public to do so? Is it because of a sort of a market opportunity that's available right at this moment? Is it an ongoing investor demand for liquidity, meaning that existing investors in the companies are looking to get out? Is it just the corporate objective of getting the public company listed on an exchange so that it has greater recognition? There's all sorts of reasons. That's just a short list. There are, of course, downsides as well, and I think those need to be canvassed. So, I'll throw it out to the panel to react and to answer some of those questions and build on that discussion in no particular order. But yeah, go ahead. Absolutely.
From our perspective, we would kind of distinguish between the perhaps the kind of larger cap IPOs, the Shopify, Lightspeed, full IPO, and then the small cap IPO opportunity. And frankly, I believe it comes down to simple math and where you can get funding at a better price and a better deal. Historically, it was traditionally the case that the public markets would pay you a higher price. And so that's why one of the reasons why companies aspired to go public, so that they could take advantage of that. More recently, the private markets have had a lot more capital than in the past, and in fact have outbid the public markets on many occasions. So it became much more of a ebb and flow. If I'm on the board of a company and it's looking at a financing, one of the core considerations is, well, where are you going to get the best deal for the company and its shareholders? So I guess I'd be interested to know what my co-panelists here think about these days in terms of where, who's paying more? Is it the private markets or the public markets these days?
Yeah, I'll jump in, and then Miles can hop on afterwards. So I agree, Rick. I think the valuations in the private market have become as robust as the public market. So we've seen private financing happening at similar valuations to what you'd see in the public. So I think to Manoj's point, it really becomes more about having the right fit with the business itself, its shareholders' objectives, and to a certain degree the strategy also. So if you're an acquisitive company where perpetually buying other businesses as part of your business plan, having a public acquisition currency can help that, because it means you can access capital generally faster and more responsively to certain situations. By all means, there are ways to do that in the private market as well. But I think one of the other things that people often don't think about as a primary reason, but in the tech ecosystem especially, it's pretty normal to compensate employees, especially tech and software engineers, with an element of equity compensation. And I would say that the benefit of equity compensation can be enhanced by having a public currency, because of course it allows those employees to have a vibrant market to sell those shares and actually see value in getting paid partly in equity. So I think that's one thing. It can also be a big brand building event for companies. So again, at a certain point in a company's evolution, it can be a big event where it helps build the kind of the brand and global profile of the business. And finally, if you're selling to large enterprise, if your customer base is large companies like Fortune 500 style companies, a lot of times the customers of the company get a lot of comfort in the transparency and the financial disclosure that comes along with being public, insofar as there can be hesitancy for big companies to do business with smaller companies because they worry about whether or not you'll be around in 2 to 5 years to continue to service their needs. And being public and having cash on the balance sheet that you can demonstrate to those large customers can help with business over time. So it's, again, I think it's a question of finding the right fit in terms of what are the objectives of the company, what's the strategy, who's the customer base, and does it bring incremental value to the company to be public and have the downsides of being public, which is all the public disclosure and scrutiny quarter to quarter.
Yeah,
Miles,
I would echo most of what Brent would say. And I think, traditionally, I would agree with almost all of it, save I caveat a couple of things. So one on, dealing with enterprise clients, you're right, having your financials in the open and showing you're well capitalized and not going away is a great thing. It also can be a bad thing if you've got a burn and maybe markets kind of shut down, which they did for a period of 6 months here, and you needed the money, so to speak. And I think a lot of that check mark can actually come, taking a little bit of step back, it's just what companies are looking for is sponsorship, right? And so sponsorship can come in the form of a great institution like Kensington, where you've got a big investor behind you that kind of said, we're willing to put our money where our mouth is. Frankly, they can go to customers, or customers can call and say, are you guys behind this? Or, et cetera, et cetera. I think there's lots of that kind of checks the box. Whereas maybe previously it was more, having that visibility was more important. I think a big part is frankly getting everybody aligned on the investor side. So if there's different people at different stages, an IPO can be a way for some to play along and go into the long term, or frankly seek liquidity, and doesn't necessarily require the company to punt out or do a major recap. That being said, almost every go public event that we do today has an element of exactness. Do I go public, or do I take private capital? Or frankly, do I sell the business? And so we call it a dual track process. And so frankly, you kind of decide at the very end which one ticks as many boxes, which sometimes you didn't know some of these boxes were important until you go through the process and figure out which one to go to. I would say, traditionally on the value side, to answer your question, traditionally, the last at least couple of years, private markets have been much more aggressive when it comes to valuation. And so lots of folks were looking at those valuations and frankly staying private. And it made sense. You don't have the headache of quarterly reporting, et cetera. The only thing I caution is valuation isn't everything in a private deal. As Rick knows, structure matters often more than valuation. So everybody kind of looks at the big numbers, but structure matters. And the one benefit on a public offering is everybody's the same. It's all common equity. There is no ratchets. There is no whatever else. So
benefit from whose perspective?
Yes, you're absolutely right. You're absolutely right. I'm thinking from an issuer or company perspective, right? So
from an investor perspective, we would be more inclined to want to be in that structure. So the benefits, typically some downside protection and things like that. I would jump in and add too that some of these other benefits, like the employee stock options that was mentioned, I think that's a really relevant point. My comment there, though, would be that recently, in the last 12, 24 months, I've seen a number of deals go by, larger, later stage deals that include some secondary component for exactly that purpose. And in fact, I had one pretty recently where we basically carved out roughly 10% of the financing and said, you know, employees who have been with the company for X number of years and had vested options, if they chose to do so, could sell out. So you do get, like, there are ways to kind of grab the other benefits that you're talking about by staying private, including using the private currency in M&A. We see that more and more as well.
Yeah, I would agree. We've seen that in our privately held companies, venture-backed companies, and growth companies, where existing shareholders who are employees have been given the opportunity to cash out. Some of these companies have come to us after they've negotiated a shareholder agreement that doesn't quite allow for that. So that's taken some negotiation, but otherwise, I can see how that can be very, very advantageous to the company to and stay private at the same time.
Well,
and let's just be.
Just to follow on that point, I think that's another big distinction between public capital markets and private capital markets. I think the private capital markets have done a very good job of late at being comfortable with giving founders secondary liquidity in private capital raises, whereas when you go public, generally speaking, it sends a bit of a mixed signal if on your IPO event you're trying to also take secondary liquidity. Because when you go public, generally as underwriters, we want management teams to tell a story about how their business is going to grow and prosper and become bigger and more valuable over time, which doesn't jive with that same person at the same time trying to sell some stock into the IPO. And the Canadian public markets have become quite comfortable with professional sponsors. So, you know, people like Kensington or other growth capital or private equity sponsors taking liquidity on the IPO, but it doesn't ring as true when the management team is trying to sell on the IPO. And so we've seen some deals struggle when they try to push the envelope there. And so I think that is an important distinction, which again speaks to how, you know, that it's not like a one answer that fits all situations. You really have to think about it. And if management's looking to take significant liquidity, we always advise them to do that in a round before their IPO. So if you have a desperate need for liquidity as a founder, you should do a private raise and take some money off the table now and get ready so that when you go public, you're going to take a back seat and let some of your professional sponsors take money off the table. But as a management team, you're going to sit back and probably have to wait until it could be as little as 6 months later post IPO in some situations, or it can be a couple of years later for others, and once you prove out the business plan, and then the public markets get comfortable giving you liquidity.
Because we don't really like it when key founders and key personnel are selling in a private round. We will be happy and accommodate a degree of liquidity, like, you know, maybe somebody wants to buy a house or something and they want to, you know, take a portion of their shares off the table. But, you know, round numbers, kind of generally speaking, I wouldn't want the key leaders in the company selling down more than about 10% of what they owned. I don't mind giving them a little bit, but they've got to be fully committed, even on the private side for us.
Right, and that makes sense. What about the types of investors? Kensington is a very senior and, you know, very well established PE and VC firm, but there's quite a wide range of investors out there. And do they all share the same philosophy? Is it the same philosophical underpinning for their investments?
Everybody's different. That's what makes
everybody's different. So like what are the different types of investors that are, you know, if you look at it on a spectrum, those that, you know, will only invest if the company remains private. They're only interested in pure venture capital. They're waiting for a sale, and that's the exit. And then there's others that are on the other end of the spectrum, financial investors. You know, I mean, you don't need to name them, but they're very much there and calculated for the company to go public in a very short period of time after they close on the investment. And I'm sure there's a range of investors. Can you guys speak to that a little bit, and so that our audience is educated on the profile of these investors?
Sure. So why don't I take, I mean, there is what Rick kind of noted on the private capital side, there is a massive amount of private capital available. So that comes in the form of venture. What once was just kind of two categories that most people thought about was venture and private equity. And then about 10 years ago, probably maybe 15 now, a new category emerged, which is called this growth equity. So basically, you've got your early stage series, seed, Series A, maybe up to Series B, and then you had your growth equity guys, Series B, C, D, writing bigger and bigger checks. As fewer and fewer, and then you had your larger private equity. As fewer and fewer companies were going public, you then had a bunch of those public investors, or frankly, guys that focus on those later stage growth equity guys, do these things called pre-IPOs. Right? And pre-IPO investors with that kind of tune of getting to an eventual public offering, or frankly, for a public institution, just putting dollars into really good and large companies because they weren't getting that level of issuance from a public equity side. That pool is big. That pool, like in general, I would call it the overall kind of private capital pool is extremely large. And frankly, I haven't seen the stat more recently, but it's in the trillions of dollars. It is a large pool of capital. In the public equity side, it is multiples of that. Now, it all depends on stage is the way I kind of formulate it, like on your topic. So if you are truly a Series A, Series B, then think of it as a venture. If you are in that mid kind of, you're through 10 million of ARR or frankly through 20 million, then think more of the growth equity, even some of the funds, Kensington and Rick, you can talk about this, like there's different forms within that. And that is a very big and very active pool of capital. And really it's, frankly, like the public markets is huge. What from a private capital side, there's lots of partners to kind of choose. You can work with somebody to help choose that, but frankly, it's each company's kind of choice. On the public market side, you as a company do not have access to that unless you go through somebody like ourselves, Brent or ourselves, to actually access that pool. So the way I kind of think about it is, there's lots of different pools of capital. I'd say the most robust are in that venture growth equity and then the pure public equity. If you want that hybrid crossbreed of guys that'll help you build up to an IPO, there is that pool, but it's much more, call it selective in the way they approach the market. And frankly, having somebody like us, I know Rick will say, don't hire bankers, but having somebody like us to help you navigate that's exactly what we do. I know, so it's a bit of an obtuse answer, but frankly, each company is a snowflake, and having somebody to help guide you through that process, it can be constructive.
Miles, I have lots of friends who are bankers. We never say that on a presentation like this. For us, so when we are looking at an investment at a A or B round or earlier, we want to see the company. We don't want to see their advisors. In later rounds, larger companies, just navigating the process, it is certainly not objectionable to see bankers helping out and guiding the process. In fact, there's a lot of value that can be added there. But part of the skill set for an early stage entrepreneur has to be capital raising and investor relations, and not just farming that out to advisors as kind of part of the reason why I think you made that comment. You made another comment though, which I want to pick up on, which is who you want to choose as your partner. And I think that's important to this topic. If you're going public, you're going to have a lot of people around, like analysts and bankers and others, but they're really outside the gates of your company. If you're in the private markets and working with a firm like ours or any other venture growth equity firm, you're really signing up with a partner who is going to be active, be on your board, and work alongside you on these sorts of decisions and other decisions as you go. So in many cases, it just boils down to a personal choice. And do you want to be independent in the in the public world, or do you want to accumulate one or two or three investor partners along the way who are going to take an active interest and active role in your business?
That's actually a very good point. I guess the whole issue of independence. I guess what's implicit in what you're saying, Rick, is that once the company goes public, it's all up to the board and the founder team to manage the process from there. Whereas prior to that, it's the venture-backed companies are heavily reliant on the venture investors.
Yeah, I would argue that independence is overrated, and that what you really want is help, because what you're trying to do is very hard, and with all the best help, many companies are not successful. So, but you're right in terms of how to think about that.
Yeah, I mean, I think what I'd add to that thought, I think to follow on the thesis there is, there's a big difference in the governance models as a private company versus a public company. And, in theory, a public company should have an independent board that's separate from management. And that board itself should renew itself over time through an independent governance committee. So, there are certainly lots of examples, unfortunately, in the public markets where things don't quite happen that way. Management still retains a significant influence over who sits on their board, although in theory they shouldn't. Contrast that to a private company example where, again, typically most growth equity investors and venture investors are going to want to have significant influence on the board. And generally speaking, major decisions will require, each of your lead investors' consent to move down a certain path. And, I think that's the other sort of important thing to note is when you're raising capital in the private context, for the most part, most growth equity funds and venture funds are just that. They're funds that have been raised. They have a fixed time horizon, and they have to deploy their capital within that time horizon and then seek liquidity for their investments within that time horizon, which is usually, call it in and around the typical model would suggest that you invest your money over 3 to 5 years, and then you have 10 to 12 years to seek liquidity on those investments and show a return to your investors. And so that is something that I think, is a bit of a contrast to the public market, where the capital you raise as a public company is much more permanent. Now, I say that a little bit tongue in cheek because, of course, each individual shareholder has liquidity and can vote with their feet on any given day on the exchange. But the point is, at that point, your board will take feedback from investors and use that as part of their input in how they guide and govern the business, as opposed to having a highly influential group of a small number of people. So for a lot of founders, that becomes part of the decision matrix as well. And as Miles said, advisors like us can help people navigate. Some managers and their skill sets are better suited to a private company board where they report to 2 or 3 effectively individuals from their sponsors that sit on their board, whereas some entrepreneurs are better suited to reporting to a public company style board that suits just better with their style of management and governance. So it's again, I think I like Miles's analogy to a snowflake. Every company and each management team are different and unique, and you got to find what's going to fit best for the situation.
Agreed. So let's talk a little bit about where the market is currently. I rattled off a few numbers earlier on in my remarks, particularly, I mean, to all of you, but particularly Miles and Brent, you see, numerous companies and and you lead a number of their financings from time to time. It's been 5 months that we've been into this COVID lockdown. That's had some impact on the market, though if you look at the indices, maybe not, I don't know. Maybe we can talk a little bit about that, as well as if you're seeing any trends in the market, particularly again with regard to tech companies. What sorts of investors and how are these investors approaching opportunities to invest in these companies? You talked about the IPOs, for example, that you've been working on or have worked on. They've been very successful, and yet what's the engagement been like between the investor and the company, given that everybody's been under some degree of lockdown? And is there a certain profile or a certain type of tech company that's being well received? I mean, those are just a few of a number of questions in assessing the market overview. So Miles and Brent, in particular, if you can kind of give us your thoughts on on where the market is and where you think it's going over the next, I don't know, 6 to 12 months.
Yeah, why don't I jump on this one first, Brent? So listen, following what was a bit of a slow April and May, I would say, as people were getting their footings, investors were figuring out kind of where things were moving, and frankly, companies were. Kind of the markets very much open up as witnessed by frankly, the rally in share prices, et cetera. So, and that kind of really blew open, I would call it, in later June, even in the midst of lockdowns, et cetera. And frankly, we've been extremely active over the last, frankly, 2 days, as well as the last month and a half, having done obviously on the larger side, which would have been the Dye & Durham IPO, which we'd been working with them for a number of years, had done some private capital raises, M&A, a whole bunch of different pieces, and then finally, when the market opened in July, kind of pushed full steam ahead, and frankly was Canada's first virtual IPO. It was like we had done a lot of work in advance, so there was a little less pieces that we had to kind of figure out, I would say, but that roadshow was a very condensed roadshow where companies are normally on the road for 2 weeks, flying across the countries or frankly continents. This was in 6 days, basically from 6 a.m. to 7 p.m. I know it's a long day, but 6 a.m. you start in UK or Europe, and then you work your way to the West Coast, and ended up building a book. We had originally tried to raise money for 100 million, ended up building a book to upsizing the deal to 172 million, and frankly, had about $1.3 billion in demand. So I would say, once people came back to their desk, so to speak, or started to get comfortable in June, we found equity raises, and that was a good one, have been extremely well received, particularly as investors kind of look at the profiles of the businesses in spite of what could be viewed as a massive potential hit to their operating businesses still succeed. Companies, investors were willing to pour dollars in. So we, last month we had Dye & Durham. We also raised money for an IT services company called Converge, which is around 20 million. This week we did 2 deals already. One for a learning management system, Docebo, for $86 million. Manoj, that we took public last year. We just did there, where ironically it was a mix of treasury and secondary. So that means dollars into the business at 25 million, and frankly the remainder was to the existing shareholders and management for Rick's piece. And it was exactly what you kind of noted, 10%, and the management team locked up for another couple of years. And then just last night we did another deal and upsized it this morning for $36 million for a company called Blackline Safety, which does oh my God, I'm having a mental. It does a lone worker safety and security solutions based out of Calgary. Anyways, suffice to say, public markets are wide open. I would even say, just for a sec here, on the private side, and Rick knows this, we've been fairly active as folks look at Series Bs, and kind of we're interested in how this market was going to evolve through COVID. I would say, post-May, after people have maybe figured out where their portfolios are, where they needed to put additional support dollars, et cetera, very much kind of the markets opened back up. And, originally funds were, cautious around not necessarily writing checks in a COVID world where you wouldn't necessarily be able to have dinner with somebody or whatever else. I would say that is, I don't want to call it completely gone out the door, but there's a lot more familiarity or frankly willingness to execute on transactions, particularly for good companies, regardless of whether it's over Zoom or whatnot. So, I would say, frankly, what we're seeing is public markets wide open, very available, particularly small, medium, and large companies. Private markets very open, and I think, frankly, Rick is going to be really busy in the fall here as private companies. A lot of people trying to do 12 months worth of work in 4 months for the rest of the year.
I mean, we've been busy through the summer, and was lamenting with some of my colleagues, like, where's the August slowdown? You know,
yeah, doesn't exist.
A lot, and
Yeah.
and one of the advantages of work from home means, you know, you can be home and you're kind of always at home. The disadvantage is you're always at work, and you know, it can be a challenge. Miles, I wanted to just mention one other that you didn't, which is when we somewhat work together. Another way of accessing the public markets, one of our portfolio companies, Blue Ant Media, sold a division called Omnia, which in the video game media sector, to Enthusiast Gaming, public company, client of Canaccord Genuity, and part of the deal was a requirement to raise more capital for the acquisition and for the combined business, and that was another one we just did. Well, you guys did, you know, a couple weeks ago. And, you know, from our perspective at Blue Ant, it was a way of accessing some public market capital, liquidity, and, you know, moving that asset into more suitable hands. But, you know, if you're wondering about different ways of becoming a public company, one way, if you're small, is to sell into an existing public company, and, you know, not for cash, but to take back paper, and then you're part of a bigger public company.
That's a good point, Rick. And one other one, sorry, just even for autonomous vehicles piece, which is probably particularly relevant here, is we did do a $10 million raise for a company called Drone Delivery Corp 3 weeks ago, which designs, develops, and implements commercial drone logistics systems in Canada for remote communities, et cetera. So it is open across the board, I guess, is the way to kind of think about it.
To me, the decision about whether you want to be public or not often just boils down to whether your revenue is big enough, and you know, profitability lesser a concern in tech, although break even is important. But you know, what scale are you? And maybe more to the point is whether you are at a point where you are able to forecast your revenue. So if you're a SaaS business that has kind of steady growth, then it's easier to be public. If you're selling products and it's chunky, especially if you're small and, you know, you don't really have visibility quarter by quarter, that can be a much bigger problem in the public markets than in the private markets.
Yeah, that Rick, I completely agree with that assessment, which is, you know, being properly ready. And again, this is where you see, you know, the RTO or the TSXV sort of earlier stage company going public. It can work very well if the company is ready. And by ready, I think your point is exactly right. Is you need to be able to perform consistently at or above the street's estimates of what you should be doing. Because, you know, for every success story on the TSXV, we've seen, you know, as many or more failures where company goes out and isn't properly ready, can't predict their revenue, overpromises and underdelivers to the market, and then their access to capital dries up very quickly, and you see those investors voting with their feet, selling their stock, and then you get stranded with the public currency that doesn't work for the company and all the burden of being public, and that's not a fun place to be. And you know, I think both Miles and myself have helped sell many public companies that were in that situation in order to get out of the public eye and be able to carry on their business in the private context following a public M&A transaction. But I think to wrap, Manoj, your question about kind of people's sort of access and appetite for technology, I would say it's as strong right now as I've ever seen in my career. And I think, you know, there's two things at play really. One is specifically tied to COVID. You know, all investors, whether they're public or private, are all looking for opportunities for companies that benefit from COVID, or at the worst aren't negatively impacted. Because when you look at, you know, your kind of traditional diversified industries, things like manufacturing and retail and consumer products, like those are all sectors that, you know, again, it's still, the jury's out on how bad the impact's going to be, but the consensus obviously is that those industries are all going to have negative impacts. Whereas if you're a software business and your workforce can work pretty seamlessly remotely, or if you're in, you know, the autonomous vehicle space where you're helping get rid of the reliance on humans for certain activities or actions, those are all areas that stand to benefit from the general theme of you know, what COVID is doing to the global economy. And so investor appetite for any story that can sort of be spun that way or legitimately is that has those characteristics is highly favorable. That's kind of the first one that's, I would say, more a temporary impact of COVID. But more broadly speaking, especially in Canada, we've had, you know, a resource dominated economy for decades. And so Canadian investors, you know, I would say have a good degree of ability to assess early stage risk when it comes to, you know, the resource economy. That's typically you go out and look for stuff, and when you find it, you exploit it. And what that's led to is an acceptance of earlier stage technology risk. So you know, there is an analogy to be said, you know, with technology companies, you go out and try and find a solution to a problem that can be solved with technology, be it hardware, software, or digital media or internet or whatever it may be. And then you go and exploit that product or platform that you built to the benefit of the company. And so, you know, the investors that historically have invested in the resource trade have come around to looking at technology companies sort of with a similar sort of assessment of risk and return. And if you're out there looking for growth above GDP growth, again, in the traditional industries, there's not that many opportunities to find growth at that pace. And so you're left with either resources or technology. And that's where, you know, again, the resource trade has come off, especially over the past couple of years, quite a bit, and people are looking elsewhere for growth, and they're finding it in technology with great success. So in the public market, certainly, that's where I think a lot of the sort of secular interest in technology comes from. And, you know, our message to most clients is that's not going away anytime soon. So while you'll have, you know, white hot open windows like we're seeing right now in the public markets, you know, even though the IPO or the public market windows tend to open and shut a little more frequently than say the private capital markets, I don't think there's any sense that there's going to be a waning appetite for high quality technology companies in Canada. And in fact, like the scarcity of opportunity in Canada is so great that, you know, if you could rewind 10 years ago, we always used to talk to our technology ecosystem participants about the discount in your valuation versus being public in Canada versus the US. What we're seeing now in Canada is actually the opposite, where top quality tech companies in Canada are trading at a premium to their US peers. And that's just because the Canadian investor community has so few options to choose from when it comes to high growth tech companies that they're paying a premium to what they could buy in the States for similar businesses.
And why is that, Brent? Just to dig into that a little bit. I mean, I've always had this this notion that in fact our image as a conservative country when it comes to you know, just about anything financial, this belies that theory, right? That actually our investment profile as a marketplace is actually very risk tolerant and accepting. So what's driving I suppose what you're saying is better valuations in Canada than perhaps even in the US?
Yeah, again, I think it just comes down to choice, right? Like if you're a US fund manager, there are, you know, thousands of public tech companies that you can choose from. If you're a Canadian fund manager and your mandate is to invest in Canadian listed companies, the number of large and liquid companies in the tech sector, you know, can count on maybe two hands and a foot. So, you know, just the opportunities are that much scarcer, which means high quality companies will attract significant amounts of capital from those public fund managers, and it drives the valuation to levels that you wouldn't see perhaps down in the States.
2 or 3 years ago, you would have said one hand.
Yeah, that is very true, Rick. Yeah, and look, and that's part of our job collectively, and what we're hearing, and I think, you know, certainly from public market investors is. And that's why you're seeing, I think Miles talked about the pre-IPO investors, which are public market investors reaching down into the private markets to invest in companies that are, call it, near the potential to go public. And that's because there's so few things for them to invest in the public markets that they're willing to go into a private situation as a way to almost encourage those companies to be ready to go public and encourage them to get out into the public markets.
I mean, part of it is also there's a number of people out there who have raised these large funds to do exactly that, you know, growth stage funds. And so they are going to compete in the marketplace to get access to those companies. Also, I think there is a Shopify effect on the whole market that I would say has, first of all, caused Canadian entrepreneurs to believe that, yes, we can do it here. We don't need to go to the US. It's caused Canadian investors to say, hey, some of these might become a Shopify. And then it's also, I think, done a tremendous amount to attract the foreign investors, not just US, but largely US, who in the past, those growth stage investors would have been very unlikely to look at later stage Canadian private companies, but now they're all keen to do so. And so, there's like that supply of capital for that later stage. I was talking a few months ago to, you probably know Dennis Kabbelman, who used to be the CFO at RIM and BlackBerry, is now a partner with Inovia. And we were talking about IPOs, and he goes, yeah, well, when we took RIM public, it was about a $40 million financing. It's like a medium-sized Series B round today. And, just the way that, you think about how the market has changed, a company like that would never have gone public at that stage in this market.
Well, and actually, Rick, that's a really good point when we talked about kind of the different types of investors that are out there. And I think it is worth noting, because you mentioned Shopify, it's worth noting geography of your investor base can actually matter when you start to think about exit, and specifically when you think about US investors versus Canadian investors, because again, there are lots of growth funds out there. The US has proliferated with tons of growth equity funds. And then in Canada, I would say the universe of growth equity funds is narrower, but there are some great pockets of capital, like you mentioned, Inovia and others. Georgian has a growth fund, and Round 13 just raised a growth fund.
The pension funds here as well.
And exactly, you've got OMERS and you've got teachers and CPP are all getting more involved in growth financings also. So I think that's important, and why I raise it is because, again, like Shopify, while it's a Canadian champion, and it's now the largest public company in Canada, when it went public, it was really a US driven IPO. So that was actually a company that went public. It was a cross-border deal, but the leads were all American banks. Most of the stock was allocated into the US market, and Canadian investors were left with a very small allocation of Shopify stock. So I think, again, that's a reaction that the Canadian public investors have had to realize that what they don't want to have happen is every high quality Canadian tech champion end up going public in a US style IPO, where most of the stock goes to US public market investors and very little of it remains in Canada. So, I'm a big proponent of Team Canada. Not that we don't have a great deal of respect for the US growth equity funds, because there's many of them done fantastic work up here in Canada. But the predisposition of most US investors would be, when it's time to exit a company, either to sell the company or to take it public on a US exchange. Whereas you see the Inovias of the world, look with Lightspeed as being a great example, where, that was a TSX only IPO, wildly successful, more than 10 times oversubscribed. And the stock has been a great performer in the aftermarket, and they've raised successive capital, for that company in follow-on deals. So, there is definitely something to think about for earlier stage companies as you're raising your rounds. Where your investors are will probably have an influence on how and what your exit or your liquidity event looks like, whether it's a sale or a capital raise into a public market vehicle.
So who controls that in an IPO? Whether you take in money from Canadian investors or foreign investors or a combination, how's that decision made? Is that the banker, the underwriter that principally makes that decision?
It's a black box, Manoj. It's black box. We're not telling you.
Black box. I was afraid you were going to say that.
Yeah, no. I mean, joking aside, like it is a decision of typically of the board and the company that's going to decide what markets to go to. Obviously, with advice from counsel and from your underwriters. But again, it's like typically that is a decision that the principal shareholders will ultimately make. And again, this is where, as an entrepreneur, your significant lead investors will have either a great degree of influence, or in a lot of cases, I think as Miles mentioned, depending on what rights were negotiated in your private financing, they may actually have the contractual right to make that decision on behalf of the company with some or little regard to what management's preferences might be. Obviously most investors would say that they'll listen to management's input and guidance as well. But, at the end of the day, if the investors have the right to determine the path for the exit liquidity event, then which you do often see as a major decision that requires consent of the shareholders, it'll be those significant sort of influential board members that are going to shape the path or the direction that the company heads in when it seeks its liquidity events.
Most management teams do not have the experience of having been public or have gone through an IPO process. I mean, occasionally you'll have maybe a CFO who has public markets experience. Maybe you'll have a CEO founder who has done it before, but overwhelmingly they've done one or two companies. The institutional investors, people like ourselves and our peers across the market, will typically do this, 7 days a week. And so, not only are we doing the companies that are in our portfolio, but we pay a lot of attention to all of the market dynamics on a continuous basis. So I think you're right that typically it's the major shareholders and board members who guide those decisions, but there's good reason for it. The management team really, more than anything else, they want it to be a successful transaction. And, typically it is a much lesser concern about where the stock ends up residing once the dust settles.
I wouldn't disagree with any of those comments. I'm just looking at the time. One thing to think about for the folks on the phone or on the call that are listening in specific on this sector, and autonomous vehicles, when there was a question, Manoj, I think you had talked about like what are investors looking for, et cetera. I would say, and Brent laid it out pretty well in terms of, there's some hot pockets as, anything digital health, frankly speaking, work from home type aspects. But longer term, I would say, where innovation is kind of key, like so differentiation. How investors make money is frankly, they get paid off of beating an index. And the way you beat an index is not to have stuff in an index. And innovative technology is a big piece of that. And frankly, for autonomous vehicles, like we've had as a country, we have a massive auto sector. We've had lots of innovation over time, and think about QNX and even on the pre-BlackBerry, et cetera, on helping, companies kind of revolutionize vehicles in general. And I would say, there is a relative dearth of availabilities within the autonomous pieces. Like there's obviously, I talked about drone delivery, which is more on commercial drones. There's a great company out east called Kraken Robotics, which does remote monitoring for ports and energy facilities, underwater pieces. But on the auto side, I'd say, there is this kind of look to the market, and there's a bunch of private companies out there, but there is, frankly, some good demand on and longer term demand for that, and appetite for that sector. And so I don't want to, the irony ends up being is there's not just good demand, but there's an opportunity within it. And so I don't want people to kind of discount it. The one thing I would say for folks to think about is, and Rick and Brent both said it, is like visibility is a big piece. So understanding whether it's step functions, having that ability to beat your quarters and not just meet your quarters, anything software related, generally speaking, positive. But if you have a good story and you have that path, even super early stage companies, and I know Brent said it, like we've taken lots of companies public that may have missed, but if we're at such a nascent part of the sector that there are opportunities, particularly on the small cap side, with a proper sponsorship. So that means having investors similar to Rick, but almost on the public side, backing you, giving you guidance, providing capital markets advice. We do a lot of that. Our retail brokers do a lot of that. And frankly, there's a group of family offices that do that in Canada that provide proper sponsorship to help companies grow. And a good example, we did that for drone delivery. Our retail network, frankly, owns a significant portion of that company, and did it by helping them along the way to getting public. And so to say, particularly for the folks on the phone, this is a market that frankly people are looking at. 1, 2, you can be earlier, but you got to be, to Rick and Brent's point, you got to be prepared, and you got to have that sponsorship and support kind of built in. But I think it's very much a real opportunity. Sorry, I jumped topics there, but I'm realizing the time, and we haven't actually talked about the sector.
Absolutely. Brent, do you have some words of wisdom to add?
Yeah, look, I think I'd echo Miles' comments. Like it's an exciting sector to be involved with, and again, I think it's one that investors have a lot of interest in. Again, both public and private. You know, there are a couple of private companies in the space in Canada that you know probably fly a little bit under the radar. But you know what many people may not realize, you got companies like Geotab and Fleet Complete are, you know, probably, well, Geotab I think is one of the largest fleet management companies in the world, based in Oakville, and Fleet Complete is another one that's a Canadian-based company. And you know that's a fleet tracking and vehicle information sort of platform for fleet owners and vehicle owners that you know drives all kinds of different value-added services from it. But you know, again, those are two very large companies based here in Canada that serve a global audience. And again, those businesses were built organically, you know, from right here in Canada, and are now world-leading businesses, you know, in their own right. And so I think, you know, while the sector is emerging right now, there's an immense amount of excitement. Again, I think because of the impact it can have on the various value chains that they impact. And so I think investor appetite and interest for stuff in the autonomous sector is very, very high.
And one comment I would add just on the sector is that my observation would be that, you know, today there really isn't a big market leader that has emerged, meaning that it's an open field. And I mean, yeah, you could argue Tesla or somebody like that, but those are such large, you know, Uber, they're such giant companies. Nobody makes that investment on the thesis of that just autonomous vehicle piece. And so that is interesting if you're in this sector and you think you can achieve that go public critical mass and then perhaps roll up other companies in M&A or do some other growth strategy to become that market leader. And until that emerges, I think it is an intriguing idea for you know, people in the space who are going through significant growth.
Here's you know, I've been sort of also looking at some of the questions because we haven't sort of done a break and then gone into a separate Q&A segment here, but I think we've covered off a lot of the questions that have come in. But one that, you know, sort of is with regard to early stage companies, somebody's asked, you know, would crowdfunding be a preliminary entry point to, or I think that the question would be on the path to a public market financing. Yeah, how do you feel about that, or have you had any experience with that?
Yeah, I mean, there are a couple of crowdfunding platforms, specifically in Canada, and then obviously a bunch of them down in the States. And you know, we have seen some companies taking advantage of the crowdfunding model to raise typically earlier stage capital. So what we've seen is a lot of it in the kind of the seed and A round. You know, less so once the companies get bigger. And again, it's probably just a function of the fact that, you know, there's lots of private capital out there seeking kind of that, you know, late stage venture from professional funds. So, but we have seen it in the earlier stage, and you know, I think it's great to see another source of capital for entrepreneurs to help them get going and get businesses off the ground and get great ideas funded. So I think it's you know, it's going to be, I think it'll be an increasingly prevalent piece of the ecosystem as technology enables. You know, these things used to be done, crowdfunding used to be done sort of through angel networks, and what crowdfunding has really done is democratize the angel networks and made it accessible to a larger portion of the population.
Excellent. Well, look, I unless you have any other comments you're dying to share, I think you guys have done an excellent job in thrashing out the important issues here. Hopefully, we've, in the course of the conversation, answered all or most of the questions that came in. So look, in wrap up, I'd like to just thank each of you, Brent, Miles, Rick. You obviously speak from a vantage point of tremendous experience. It was a great conversation. I'd love to continue this with you guys in future sessions, but at this point, I'd like to thank you very much for your participation. I'd also like to thank Avon again. They've done a great job, and as I said before, being an agency that fosters this sector, for reasons discussed. I think personally, my personal view is it holds a lot of promise for Ontario and Canadian companies. And of course, you, the audience who have participated, hopefully you've taken some wisdom away from this conversation, and I'm sure we'll have future sessions where we'll be able to track you back to expert speakers like the ones we had today. So thanks again to everybody, and have a great day, and stay safe.
Thanks, everyone.
Thanks, Manoj, and thanks,
You
David.
too.